Joining us for this conversation, however, Oluwatoyin Olaoye is a Chief Risk Officer at Vendor Credit. Great to have you on the show.
Hello, Larry. Great to be on the show.
Yeah, great to have you. So, first off, let's try and understand this financing gap in Africa. We know this is, rates setting season, and we're seeing most of the central bankers, easing interest rates right now. And I'm wondering how this, plays into that whole gap, when it comes to SME financing on the continent.
Okay, thanks for that, Larry. So I think, first of all, we need to just, ensure that there are clarifications about what we mean when we say there's a trade financing gap and what it essentially entails, right? So your trade financing gap refers to the difference between the demand for trade-related financing, so things like letters of credits, trade loans, invoice financing, and the instruments that actually support this, right? So if there's a mismatch between those two things, then we say that there's a trade financing gap. Like you rightly pointed out, the CBN, especially in Nigeria, at their NPR sitting a couple of days ago or yesterday, reduced the NPR to 27% from 27.5 where it was previously, and also reduced the CRR. And so basically what this means is that it allows a bit more flexibility for financial institutions to be able to extend credit to sectors of the economy that actually need it. A good example of this is if you had 100 billion, right, sitting in the CBN, or 100 billion, and the CBN CRR, which was previously 50%, meaning that 50 billion would thereby be sitting in with the CBN and would not be available to be lent, right? But with the reduction to 45%, what you currently have is a situation where you have an additional 5 billion, basically, that banks can lend to sectors in the economy, such as the SME sectors that actually need it, and then ensure that that the economy continues to grow.
So, which sectors or regions in Africa would you say are most affected, and in what ways? We keep talking about boosting agriculture, manufacturing, getting more exports out of Africa.
So you've hit the nail on the head. Agriculture is the number one sector that is most affected by this gap in financing, right? A lot of the banks, or financial institutions generally provide financing around sectors such as chemicals, consumer goods, so FMCGs basically, because those goods are basically recession proof and there will always be a demand for it. But we find out that there is a most lack in agriculture, construction and real estate, electricity and power, and then ITC, communication, and then pharma. But the most is notably agriculture.
All right. So, as a chief risk officer, how do you assess, and manage risk associated with providing, supply chain trade credit to SMEs, especially those with, limited credit history or collateral? And I'm sure this recent rate cuts, I guess, is also bringing some kind of excitement to you, I guess.
Yeah, so for us, we take a novel approach to a lot of these issues, right? Whereas financial or traditional institutions rely on things like financial records, CDD on who the promoters of the business are, how many years in operation that the business has been. There's something called open banking infrastructure, which we take advantage of, right? So you get a lot of details from things like bank statements, right? Bank statements will typically show transaction history, balances that remain, sales records on e-commerce sites. So if the person has been a merchant on any particular site e-commerce that you have in the current marketplace, right? That sales transaction also tells a story about how well they've done, what their order book is like, how many orders they fulfilled. You're looking at things like high sales or repeat orders from verified corporates that give signs of reliable performance. Then customer review ratings, right? You can assign weights to customer review ratings. So on a lot of the sites or a lot of customers, or even on Google, right, you find out that customers have left reviews. And based off of this, you can assign weights that will allow you to ensure that you essentially mitigate your lending risk, right? Also, reputation in the industry. So you have vendors who are supplying multinationals or different corporates, right? You look at the reputational risk of the counterparty if they fail to make a payment as at when due, and that feeds into the risk inherent for the vendor or the supplier that you are providing credit to. So a lot of these things, right? We've created a novel approach whereby we can score credits for we can score and mitigate credit risk for a lot of suppliers who deal in trade finance and in supply chain financing, right? As opposed to the more inflexible and somewhat standardized process that larger financial institutions utilize.
And definitely bring it back to Nigeria now with this recent rate cut. We're now at 27% from 27.5% with a 50 basis point cut there. But I'm wondering, how would the average SME, feel this interest rate cut, in your opinion?
Okay, so basically, like I mentioned, right? So the interest rate cuts allows for it allows you to lend more, right, at a lower interest rate. Like I mentioned, it has created more liquidity for the banks, right? So first of all, looking at it from the CRR reduction, right, lower CRR frees up more cash for commercial banks or financial institutions, right? Since we have, or generally they have to keep less money with the CBN, right? That leads to cheaper cost of funding, right? So there's more liquidity in the system, and more liquidity in the system ensures or pushes interest rates lower, right? Because then everyone is trying to ensure that they can lend to as many people as possible so that they can get benefit of the lower interest rates. So all of that, if you look at it from a supplier or somebody or someone that needs credits point of view, right? It means that there is more money and there are options for them to go around, right? For them to access financing, because then the banks are going to be able to deploy those funds into sectors that actually need it. So the reduction in interest rate in itself is a good one for the economy and for trade financiers as a whole.
Right, and talking about closing gaps at this point, let's imagine we finally close this trade finance gap. What is that going to, translate to in real terms for the African economy?
So in trying to close the trade finance gap, right? You are looking at ways where financiers themselves can get cheaper cost of funding to enable them to do more trade, right? Increase in exports, right? Increase in employment. It allows your SMEs to generally thrive better, right? So there are a lot of benefits to ensure that this gap is closed as much as possible. All we can continue to do at our end is to ensure that the people that actually need this capital get the capital by ensuring that those funds are deployed to the sectors or the SMEs that really need it, and they're not just made into a sound bite that, oh yes, we've given out so much money and then you don't see any effect, right? Because at the end of the day, SMEs are the engine of the economy. So our role is to ensure that the funding gets to sectors and SMEs who actually need the funding, to ensure that that trade gap is closed as much as possible, and so that the economy as a whole continues to grow. If that grows, it has a trickle down effect on where interest rates and where prices of goods and services will be eventually. So all of it in itself, there is a pressing and there's an urgent need to ensure that we close that gap as much as possible.
All right, definitely. We'll keep tracking to see how much progress we make going forward as a continent and as a country. Thank you so much. Oluwatoyin Olaoye is a Chief Risk Officer at
Yes,
Vendor Credit. Thank you for coming on today.
Thank you very much, Ladi.